Where does this ugly November rank? Spoiler alert, among the worst Novembers in the last 25 years. What will the Fed do in December? The market is split, the Fed is split, and investors are nervous. And how will the AI crush reshape our aggressive CG and DS portfolios in 2026? Pain now, opportunity soon. Stay with us. It's the Monday morning update with CB3 Financial. I'm Charles Brown, your portfolio manager, and CB3's update begins now. Last week was another bruiser for Wall Street, especially for anything tied to growth, tech, and AI. All three major U.S. indices finished the week in the red, each down roughly 2% or more as the sell-off that started earlier in the month continued to feed on itself. I'm not surprised by this, and that's really what I want to focus on in this podcast because many of you, I'm sure, are concerned about where things are and why we're seeing such an ugly November when it has historically been, for the last 25 to actually more like 50 years, the strongest month of the year. So the pattern was pretty clear. AI and mega-cap tech stocks led the downturn. Nvidia, Palantir, and other AI darlings, as we call them, saw more pressure as investors finally said, valuations do still matter to me, and I'm not buying at these prices. Thus, volatility spiked. The VIX jumped as intraday rallies kept getting sold, especially after Nvidia's earnings couldn't sustain an AI relief rally. Now, the day after Nvidia's earnings report, the stock opened up 5% and ended up closing down 3%. So it's not a surprise there. It's hard to hold valuations when the market is so dependent on Palantir and on Nvidia and on Microsoft and Amazon and all the big trillion-dollar companies to keep things going. So what happened? There was a rotation into the defensive sectors. That helped GI, but it doesn't help CG or DS. Money flowed into more defensive names and quality value classical, hey, I'm tired of getting punched in the face by high beta stocks. That kind of behavior is what we saw last week. I'm not concerned about it. This sort of thing doesn't usually happen in November, but it always happens throughout the year, at least 2 or 3 times. So layered on top of that, the Fed expectations for a December rate cut got muddier by the day. Some big houses that have been calling for a cut quietly walked back that after stronger than expected jobs data, while others are still hanging on to cut their forecasts. So last week was all about repricing risk in rates and in AI, and in the broader equity market, it was just an ugly finish. So just to give us a perspective, where does this November rank? I mean, how bad was it? Well, it's been rough. And where does it rank in the last 25? So here's the context. Historically, November is usually one of the best months of the year. In fact, the best month for the last 25 on average. Since 1980, that's 45 years, the S&P 500 has averaged around a 2% gain in November, the best average of any month. This year, completely flipped, completely flopped. As of last week, the S&P was down roughly 3% for November, and the NASDAQ off 5 to 7%, driven heavily by AI and tech. And as you know, that's where we have much of our investing in DS and CG because that's where the growth stocks have been for this year, 2025. So several analysts now point out that November 2025 is on track to be one of the worst Novembers in the last 25 years. I think it could be the worst in 45 years, right down there with the post-2008 Euro crisis years. So if you line up the last 25 Novembers or even 40, this is one of the very bottom of the barrel and definitely the worst 1 or 2 out of the entire sample. Does that mean the market's coming unglued? No. It just means that risk and fear have shifted from October and September to November this year. And there's a lot of reasons for that. So what's driving it? AI and tech are unwinding. It's been an incredible run. Doesn't mean it's ending, but it does mean it's pausing. And any wobble in the earnings or guidance has been enough to trigger profit taking. Investors feel uncertain because the Fed is uncertain. The market spent most of 2025 front-running rate cuts, and now we're heading into the final meeting of the year with no real clear consensus. And Jay Powell has said, look, this rate cut is not guaranteed. And the problem is, of course, that they are not united at the Federal Reserve. Those 12 governors are split in their vote. So if your November performance feels like it was worse than last year, well, it absolutely is. This is not a normal November. It's more like a mini 2018 or a mini compressed 2020 or even a 2022 flashback dump in the market. So for CB3 clients, this month will show up in the statements, of course. We'll talk more about this on the December 11th show and how we respond to a month like this, not emotionally, but systematically. So what will the Fed do in December? That's, of course, the big question right now. What are they going to do? The final FOMC meeting is scheduled for December 9th and 10th. They meet on the 9th. They make an announcement at 1300 hours Central Time on the 10th, which is a Wednesday. Right now, the situation looks like this. The Fed is split. Some officials are openly worried about the labor market, hinting that current policy is moderately restrictive and could justify a near-term rate cut. Others want to wait for more proof that inflation is under control. Wall Street is also split, and some Wall Street houses have dropped their call for a December cut after stronger than expected job growth. Others still think that a 25 basis point cut is on the table, mainly because unemployment has drifted up and the growth story has cooled. Under the surface, things look weak in the U.S. right now in the employment front. The futures markets have been bouncing around, but the rough message is this: slightly higher odds for a no cut in December, with the first cut now pushed into January 2026. But it's still close enough that one speech or one data release could tilt the whole thing in the favor of 125 basis point cut. It's not going to be 50 in December. That's almost a certainty. What does this mean for us? If the Fed holds in December, but signals multiple cuts in 2026, that's actually not a disaster at all. Then that would be us knowing in advance we can expect 3 or 4 quarter point, 25 basis point cuts in 2026. And the market would look forward and say, look, we can live with that. So if they surprise us with a cut, we probably won't get a relief rally. And then the usual, well, now what are we going to do? So the bottom line, I don't think December is about a 125 basis point move. I think it's about the path that they sketch for 2026. And that path will heavily influence the next leg of the AI trade and high growth in equities. So on the December 11th CB3 Live show, we'll take a look at what's developed since this podcast on the Fed decision, or the odds if they're still playing coy, and translate that into actual positioning for each of our 3 portfolios. So now what about the AI crush? Well, that definitely is what's affected the downturn here in November. How will it affect us in CG and DS? Well, pretty ugly. You guys have seen that if you're looking at your statements. But again, this kind of behavior always happens at some point during the year. It's just really, really unusual to have it in November. Okay, not a big deal. Instead of September, instead of October, it's happening in November. So the last few weeks have been a reality check for AI. Nvidia and other AI bellwethers have meaningfully pulled back in November, even after strong uptrends were reported and blowout earnings. That wasn't enough to assuage investors who are saying, you know what, this is just getting a little too costly for us and we're going to take profits and move on. So for CG and DS, we think that there's going to be some rough roads continuing this month. I do expect December is going to be calm, and I still think we're going to look much better in January, especially if the Fed hints at the December meeting that, look, we may not cut right now, but we're going to probably have 3 or 4 cuts in January because we think the coast is going to be more clear at that point. So here's the hard truth. In the short run, volatility is the tax you pay for owning leadership. We buy leadership in our programs. Even in GI, which is a conservative program, we're always looking for the leaders in every sector, and that's just the way it works. We're looking for strength, all right? And we sell weakness. So when AI gets sold, our aggressive portfolios feel more like a plain vanilla index fund, all right? No surprise there, but that doesn't happen very often. You can look at the performance of DS and CG and see that. So what's the opportunity here? The opportunity here is to wait for capital expenditures and infrastructure to catch up, and we will see in 2026, I think, a show me income statement from these major companies out there, and there's going to be continued growth, and we're going to see more stories like Nvidia, which just continues to sell more and more and more chips. So that's a positive. So our response is going to be to keep tilting these portfolios toward growth. I don't see that as changing. So the AI crush is the market's way of saying you're overvalued right now and we're not going to purchase you at this time. All right, no big deal. By the time we get to Thursday, December 11th, which is our final show of the year, I'm going to know which AI related names are still out there that we want to continue to own aggressively, which ones we want to put on probation, and which ones are up and coming that could be ready to really make strong moves in 2026. All right, that's what we're looking for. So December, it can be a difficult month, but often it has been a strong month. It's usually been between 3rd and 4th on the calendar of the 12 months. So we're watching to see how we finish November and then head into December. So stay with us. We'll be here for the December 11th CB3 Live show, our regular monthly Thursday night show. Join us for that. Hang in there, folks. It's been a pretty good year so far. Not quite as good as 2024, but still been a pretty good year. And I think going into 2026, again, with midterm elections, usually that is a positive for the markets because Congress is probably going to want to do things that make people happy. All right. You guys have a fantastic Thanksgiving. I will see you Thursday night, December 11th. Take care. God bless. And we'll see you next time.